Commercial property, it's a big one when it comes to building a portfolio.
When you're in a position to exit out of those residential properties, on a commercial, you're getting double the rent and it's net and it's a lot less to manage. Sooner or later, you're going to have to transition that wealth into a cash flow generating asset.
Because from a finance perspective, to know that, it's so important.
When you've got a commercial asset in super, your ability to generate a deposit is much better.
See, that's the key part that people need to get. Yeah.
What's going on, guys? Welcome to the Property Nerds podcast. Now, a lot of residential investors know that commercial property is the end goal. They're just not sure when and why you should get into it. Let's unpack that.
Nerd alert! Property Nerds, the home for data-driven property investors, where we uncover Australia's hot and cold markets, latest headlines and trends.
Welcome back to another episode of the Property Nerds podcast. And Jack, mate, love the intro for today's episode. We're heading into the world of commercial property. Short, sharp, sweet, straight to it. Commercial property, it's a big one when it comes to building a portfolio, because for those that aren't in the highest of income or high capital holding brackets, it's the end to the portfolio as you consolidate down. But then there are those with the high incomes that can transition to it earlier on in their journey, right? But I guess I want to talk about the transition to it because from a finance perspective, to know that, it's so important because that feeds into your greater strategy too. So let's talk about the resi to commercial transitions. And I want to start off with you, Jack, in terms of what some considerations should be when people are transitioning from residential finance over to commercial finance.
Yeah, you said it well initially. So there's typically what I see is two main pathways of people exiting out of residential and into commercial. The most conventional way is just to build up a residential portfolio all the way up until you're ready to retire into the later piece. And when you're in a position to exit out of those residential properties and into like a blue chip commercial, then that's pretty much the exit strategy. And that's the conventional, simplest way to put it. But there's another, like if you're a person who has a high income, you probably started investing quite early and you're in a position to exit out of your portfolio and into a commercial asset that's blue chip, but you're not even ready for retirement, like that's okay to get that, because you can also go back and start investing back into residential into a separate entity to continue just to rebuild that residential portfolio and then kind of exit into another blue chip asset when you're closer to retirement. So
that also proves to the point of structuring while you're doing this, right?
Yeah.
Because if you structure that commercial, say, in the personal name, then you're not really holding it as efficiently. Would you say that's fair? I mean, without giving obviously structuring advice, let's just unpack it a bit more.
Well, if you're exiting out of residential and into commercial, and that's, say, it's like a 2.5 mil at 70% LVR, right? Yeah. That's going to be positively geared from day one. Yeah. So you can pretty much exclude that debt without an assessment rate from day one.
See, that's the key part that people need to get, is that the commercial, whilst it's higher capital, more intensive, you need a bigger deposit. If you actually exit the residentials into it, you've solved the deposit problem because they usually come from the growth of the residential assets. Second, you've actually just created a whole new wave of borrowing capacity because now you've got that first asset, positive cash flow in a trust or a company. Yeah. You can now move on to the next wave, like you said, going back to residential. But as you go back to residential, that 2.5 mil asset in commercial is actually excluded from a liability.
Because when investors start early and they can, like if you just compare that to a 2.5 mil residential portfolio at 70%, like it's, borrowing capacity, but what about affordability? Like on that size portfolio, on a commercial, you're getting double the rent. And it's net and it's a lot less to manage. Yeah. So typically when people want to take it to that next step, or they've got a massive residential portfolio, they just want to take it to that next level, exiting into commercial and then restarting into residential can be a really good option.
That's a really good one. So you can actually not just hold resis forever and then exit, but you can hold resis to a point where it gets you that commercial, exit it, get into commercial. Exactly, right? 2.5 mil plus, that's the sweet spot. Then you're into commercial and then you can actually go back to residential again.
Quite easily.
And you can almost repeat it again, right?
That's right, yeah.
Okay, interesting. Adrian, do you have any thoughts on the resi to commercial transitioning? Because we've got two different scenarios there. Both of them work for depending on who the investor is. Yeah. What are some of the things you see on the portfolio planning side?
Yeah, it's like Jack said, when we see those two different scenarios, it ultimately depends on what they're looking to get out of their portfolio. You know, we don't just we're not just reactive in terms of purchasing for the sake of purchasing. It's, hey, why do you want to purchase this asset and what is it actually going to do for your portfolio and the goals that you're looking to do? Naturally, when we talk about the residential to commercial transition, the typical answer or response is that it's for retirement. It's to provide that passive income so that people can reduce their work hours or, transition into retirement there. But what you've mentioned, Jack, is basically just continuing the journey with this alternative strategy where we are maybe selling off a few resis and going into that blue chip commercial to ease the cash flows as well as increase the borrowing capacity or, get your borrowing capacity back so that you can go on that next wave of accumulation. So you can kind of see this as a sort of continuation or a different step to expand the portfolio further. Whereas if you just kept going down that residential pathway, you're going to get stuck for, one of those two reasons, whether that's your borrowing capacity or whether that's you having, 5 or 10 negative cash flow properties that really eat into your cash balance there.
I mean, we bang on about the cash flow of a blue chip commercial asset, but it's not to say that it's not going to grow in value. When you're up around that 2.5 mil value for a commercial property, it's definitely going to still increase in value. It's just that that's not the focus. Once you get to a certain point, at a certain point, you want to have a more affordable portfolio and get a higher cash flow, but you're still going to get that capital growth.
Yeah, absolutely. And it's like, we're not concerned about paper wealth.
Yeah,
do you know what I mean?
that's
At
right.
that time, it's like we're trying to turn the paper wealth, not just to look at the figure, it's cool, top line, like residential has. It's like if you're making that transition to commercial, it's about the day-to-day impact to your living. It's the day-to-day impact to your holding position of wealth. And look, even at the 2.5 mil commercial balance, let's just take a 2 mil commercial balance, even if it does say a 3 to 5% growth just based on the basic rental increases that might happen. Obviously 5's a bit aggressive if it was just on rental, but let's just say it was 5. That's $100,000 in growth because of that scale that's happening.
Yeah.
Now, if someone had $100,000 of growth in the residential world, they'd be like, all right, let me unlock that. Let me get the equity out. Let me try and get the next. That's great in an acquisition phase, but that doesn't really produce any income. It's just paper wealth compounding,
Sooner or later, you're going to have to transition that wealth into a cash flow generating asset.
Absolutely, absolutely. Now, I want to share from my personal portfolio, the residential to commercial transition. So this just gives people different, opinions, because you've had one that's talked about residential to commercial over time. Then you've also mentioned residential to commercial, then back to residential. I want to give another way you can look into this from a business owner lens. And the people that run businesses over time, they have surplus profits in the company. And when they have surplus profits in the company, we call this effective treasury management, which is like, okay, let's just say you have $1.5 million beyond your cash buffer management in business and beyond your tax payments that you've got that year. So now taxes are clear, cash buffer management's there, and you have 1.5 million extra cash. Now, if that's just sitting in an interest account, you might be getting 3 and a bit to 4 and a bit in interest. Whereas if that $1.5 million cash is a 30% deposit plus 5 to 7% cost, buyer's agent, stamp duty, lawyers, all that sort of stuff, and you put that towards a commercial property, that might be a commercial property in the vicinity of close to $4 million. Yep. Right? Now that $4 million is also, like you said, growing at a top line. But the second and third thing people don't recognize is the second thing is that if you're buying in the right company structure or trust structure, your tax rates aren't moving that cash from a 25% corporate vehicle all the way to a 47%, top individual tax bracket. Yep. They're moving to another corporate entity. Yep. So it's very similar in the tax brackets. And so now you've just moved the money that you've already paid tax on to another entity that's focused on generating wealth and income. And at the same time, because it's near that 30% deposit, you're able to get a healthy loan on it without as much concern.
Well, it's positive cash flow too.
Positive cash flow too.
Which is only going to get better.
Now, if you're averaging a 6.25 net yield on that money, that's the same as just under 5 or near 5% on your own 1.5 that you invested. So in my head, I'm like, I'm not paying any or much more tax on that overall capital. I've already paid the corporate tax on it. I'm also not getting a 3.5 to 4% on the bank with no capital appreciation. I'm getting capital appreciation of $4 million asset. Yep. Plus at the same time, we're getting near 5% returns on money. And then if that was your business strategy, on a personal front, you might use your increasing borrowing capacity or trust structures. And this is what I'm personally doing, to use equity to buy residential. So it's like leveraged debt, leveraging it to high amounts, 80 or 90%, building residential compounding growth whilst I'm young in age, using equity. But then business profits, you move that into commercial at high value assets, low frequency purchases, maybe once a year as a treasury management strategy, and you're able to continue to make that money smarter and work harder for you. So I think that just gives you different ways to transition to commercial, resi to commercial over time, resi to commercial back to resi, consolidate, or in business owner world, you can have commercial as a management of business profits, and then residential as a build wealth aggressively through leverage, and you can have the best of both. So that's commercial and transitioning, guys. But what about the world of SMSF? Because again, that continues to pop up in popularity.
Yeah.
How is SMSF commercial different in terms of resi outside of SMSF commercial?
Yeah, well, it can be different because sometimes you don't have to start residential. You can go straight into commercial.
Got it.
It just depends on the balance that you have and the borrowing power that you have. Because with SMSF commercial, you can do 80% loans, 80% LVR loans, 30-year loan terms. And
that's a big X factor.
Which, your borrowing power in SMSF because of that is really good. And it's not something that's as available outside of SMSF. So it's a really... It's quite good. Your borrowing power for commercial, like if you have a $700,000 to $800,000 balance in your super and your income's pretty good, and you can get above $2 to $2.5 million on a commercial purchase right off the bat. Typically, that's a better option than going into residential first and then exiting.
Multiple.
And like some people, if you've got a $200K balance or a $400K balance, well then it would be better to start residential because you're in that 2 properties for $800K. Right. And because you can't really get a quality commercial asset at $800K.
Yeah.
And, so typically, if you have $400K to split that in half, get 2 properties for $800 on the resi side, you can get capital city investments for that. And then, you can build up that net balance to exit into commercial at a later date.
Yeah.
But your ability to, go to commercial and then back to residential is quite good because you can't access the equity in an SMSF property. Right?
Yeah, you can't do it from the equity loans.
It's all cash flow. So when you've got a commercial asset in super, your ability to generate a deposit is much better.
Yeah, because the cash flow keeps funding it, the balance keeps building back up, and also your contributions now are not going towards a loan.
Well, it's not negative geared either.
That's right.
Your contributions and the rental income is going to start building up a balance. And then it's like for you to get another quality residential property, you only need about 150K as a deposit to get something for like 600. And then you can rinse and repeat that process or just keep it until beyond retirement because the tax advantages, even in accumulation phase, when you exit or if you delay that till post-retirement, you're going to keep a lot of those profits.
Massive. Well, guys, thanks for diving into the residential to commercial. Chris, our partner of commercial investments, his ears must be buzzing today. He'll be like, hey, let's get onto the commercial show next and talk about it. Jack, would love to actually have you on that show.
Sure.
Go deep into it, unpack the numbers to a whole new level on that transition point and just go further from there. And same from your side, Adrian, the strategy point, actually unpack the exact moment of where it should be in a portfolio and why. So I reckon we'll do a round 2 of this, but on the commercial podcast, because Chris would love to pick the brains on just going deeper into the moments of finance and why it makes sense and how it makes sense. So for those who are really interested more in commercial and I guess want to just learn more on the finance side, Jack, because it starts with finance before you can understand it, how can people reach out?
Yeah, just go onto fouracrefinancial.com.au and you can book an appointment with someone in my team.
Awesome. And if you love commercial content like this is just the snippet of it. There's so much deeper that we can go into, which we do go into on our commercial property investing podcast, which is also part of the InvestorKit group. So do check that out where Chris and I go into it further. We're going to invite these guys in to be able to actually go deeper into some of the numbers. We'll bring up exact loan terms, cash flows, unpack that even more on a deep dive on commercial lending within the commercial property podcast. So check it out and thanks for tuning in today.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Game over.